Thank you very much. Good morning, everyone, and it's a great pleasure to welcome you all today to this fantastic panel discussion. My name is Amina Turgulova, Regulatory Advisor for GBBC, and today I'm a proud moderator of this distinguished panel. And as institutional adoption is growing and the public blockchains have been onboarded by the financial institutions, there is a pure need for the risk mitigation framework. The first phase of capital markets risk mitigation framework, which was an industry-led initiative, has been completed in July, and currently the document is open for public consultation until October 3rd. If you haven't yet familiarized yourself with this document, please scan the QR code on the back of your badge. And for those of you who are watching us online, please follow the link in the live stream chat. Before we start, I would like to ask our panelists to introduce themselves. Otto, may we start with you?
Hello, everybody. My name is Otto Nino. I'm a Technical Business Development Director at DTCC for digital assets.
Hey, everyone. Wyman, Choon, Chief Legal Officer at Otto Labs. At Otto Labs, we develop software to help others use the blockchain. We also provide infrastructure services for businesses to be able to take advantage of the blockchain.
And I'm Michael Wagner. I'm a partner at Wyman. We advise our clients on the adoption of blockchain and the change of business models that comes along by using blockchain.
And I'm Jorgen Ouaknine. I'm the Global Head of Innovation and Digital Asset for Euroclear. I usually like to say when I'm in the US that Euroclear is the DTCC of Europe. We do custody and settlement for over 40 trillion of euros, and we process every month around the world GDP on our books.
Thank you for joining us today and sharing your perspectives. And Michael, may we start with you? Let's talk about the origins of the capital markets risk mitigation framework. What needs does it solve for the digital assets ecosystem?
Yes, I think 1 year ago, more or less 1 year ago, we all sat down in the capital markets group and basically said, blockchains are good for capital markets. Why aren't they broader adopted? What is holding back tokenization? And as you also probably remember, the Basel Committee had just issued its view that permissionless blockchains are dangerous. They need to be capitalized very highly. So the group basically looked at it and said, why don't we aim to understand what is similar to today's world and what is different in the terms of risks that blockchains bring, and how does it fit into the risk framework that most financial institutions are using, in the hope that, and the hope really was dual. One was to explain to regulators that actually these risks can be managed, that we are in a position to understand and manage and control these risks today with today's tools. And then secondly, hoping to get more financial institutions to look at blockchain as a way to improve their businesses and as a way to increase their use of capital markets products, use of tokens, and so forth. So those were the dual goals. And then we set off as a relatively large working group of L1s, financial institutions, and FMIs, who are big intermediaries in this whole process. So we basically looked at it and we came up with the RMF, so the risk management framework for non-financial risks, that basically lays out how institutions could be incorporating the risks that emanate from blockchains into their business and control framework so that they could actually use and adopt them.
And Otto, would you like to share your perspective of why DTCC has become an essential part of this risk mitigation framework?
Of course. Well, as you may know, as FMIs, we help the industry in managing the risk, right? That is our main mandate, and provide the tools that will help understand this risk and give the tools to manage it and mitigate it. So this was a great addition to the framework that we have been institutionalizing for decades. But in this new era where it requires more diligence and more logic, I would say, in analyzing what are the securities that we're guarding and for whom, right? Guarding the value of the assets for the industry and for the investors is one of the main drivers of moving into digital.
Thank you. That definitely sets the stage and answers some of the questions why behind this effort. Otto, may we stay with you and may I ask you about the institutional lenses, what challenges and advantages do institutions see in adopting blockchain technology and tokenization?
Well, there's several. We have been discussing in the preparation for this all the angles, but I think the one that is most apparent right now and hard to deal with is that conversion of the processes. And let me explain what I mean by that. We come from a TradFi or the traditional finance rails where the processes were the ones that mandated even the shape of the assets or how we will operate around them, right? Stakeholders will operate around the process that was created for that security. In digital assets, that's turned around. In digital assets, the process is within the asset. The data becomes the DNA of the asset, and all those processes, ancillary services, stakeholders that used to come after the asset was issued need to become part of the design of the asset, right? We need to think ahead how that asset will be post-traded, will be managed for traceability, will be managed for reporting. So it's a change in the logic of how you go about the business of creating assets, maintaining assets, and processing assets. And I think that's a challenge because we come from a traditional financial culture of following the standard and adjusting to the standard. Now there is no standard, right? That's one thing. The other thing is the translation in terms of not only the languages and the coding and those, which of course poses some challenges, but the translation from that traditional finance where the rights of the investor, the rights of the ownership of the asset were very well guarded in a specific structure with legal contracts, with authorities and hierarchies. That is completely broken down now, right? Now is much more difficult to trace the ownership of an asset when it has gone through several layers of transactions through different ledgers, not layers, right? Networks, and it probably has been wrapped into a different code. There's so much more layers that need to be understood that is hard to digest for whomever has been traditionally working in a specific way, right? So in our case, for example, move all the processes where we have involvement with accounts and banks and custodians and the Fed, and is really have to move a whole machinery to adopt across the board this new technology. But there's only one way to do it, right? Which is getting into it. I think those are two of the many challenges that I could mention, but I'm sure that we have experienced one more.
Thank you, Otto. Jorgen, would you like to share your perspective?
Yeah, sure. First of all, coming back to the risk mitigation framework, I think that more than just a great work, it's a very strong signal to the market. When you see this kind of work coming out, it means we are closer and closer to actually, scale and adoption, which has been missing for some time. And fair to say that this kind of work for institutions like Otto mentioned, like, we're super regulated, we're trusted. I wouldn't say it's part of the business as usual, but if you look back at all the major changes of the past decades, we have had to adopt the way we think about new technology, new business. Look at the cloud. At the beginning, it was a big challenge. It was, on-prem, then, it was only private cloud. Now it's public cloud, and it comes with new non-financial risk as well. So how do you adapt the way you operate to the ever-evolving, changing world? So now it's the moment of blockchain here. And we see clearly that, there has been, I like to be a bit provocative. So sometimes, people finding excuses not to scale and adopt. And at the beginning, it was, there's no liquidity. So somehow the liquidity challenge has, progressed significantly and has been somehow solved, I would say. Interoperability was a challenge. People are working on that. Now people say, we need cash on chain. Well, guess what? It's coming. And now the question is about standards and exactly the work we're doing. So I think, combining all that together shows clearly that the TradFi and the DeFi and all the regulators as well are coming together and saying, we need this kind of work to be able to progress in concrete implementation to get the industries ready inside each company to have the proper frameworks to be able to scale and adopt more digital asset going forward.
Thank you. These are all excellent points about opportunities and challenges, and that naturally brings a question of trust, how regulators, institutions will trust in the systems we are building. Wyman, may I address this question to you?
Yeah, sure. So the risk mitigation framework when I first heard about it, wasn't quite sure what to think about it because I'm not traditionally a risk person. But as I dove into it, I realized what was most useful, at least from my perspective as a lawyer and a technologist, is that it has actual mitigations proposed for each of the risks that it identifies. And this goes a very long way towards dispelling misconceptions that regulators, users, businesses have about the technology. Michael mentioned sort of the Basel III Committee's view that if banks were to use public blockchains to tokenize their assets, they'd be subject to much higher sort of capital reserve requirements. I think the last number I saw was it'd be subject to the maximum percentage of 1,250%. And that basically makes it something like 12 times more expensive to issue a stock on a public blockchain than you do sort of a traditional DTCC style custody and ledger system. So this is unfortunate, right? Because it allows sort of arguments like that to be put forward without real discussion around ways to sort of mitigate that. But if you look at the framework, they come up with some very concrete suggestions. The Basel Committee basically says banks should know every node on a network, which I think we acknowledge is fairly difficult to do. But the mitigations in the framework talk about things like perhaps financial institutions should run their own validator nodes, right, so that they can see the data happening in real time as transactions happen on chain. They should diligence the service providers that run nodes on their behalf or provide infrastructure services so that they can bring the business on chain. So I think a lot of these mitigations really cultivate trust because we've got some a scientific approach to responding to concerns that regulators or the public may have. And perhaps 3 to 5 years ago, it was okay to sort of bandy around these misconceptions and sort of get stuck in these discussions. But it's 2025, with a whole new world. The technology has clearly proven itself. BlackRock has a money market fund that's tokenized, right, called BIDL. Lots of banks have done public bond issuances and experimented with launching stocks on chain. So I think it's time to sort of look at the benefits of tokenization. There's plenty, but just on sort of like transparency, when a stablecoin issuer issues more stables, you can see exactly what the supply is of circulating stablecoins. You can sort of see where they sit in what wallets. If they're moved, that becomes monitorable as well. And so it makes TradFi work in a more secure way because if you are pledging your assets on chain, you can see which wallet it sits at, right? Who sort of has control of those wallets, for example. So I think that the mitigation framework really goes a pretty long way to getting folks to understand that there is trust built into the system, but here's an additional layer of understanding the risk and how to deal with it.
Thank you, Wyman. Of course, building trust is clearly fundamental. Let's now explore how traditional market players actually practically implement blockchain in the existing frameworks and what type of misconceptions the RMF is helping to address. Michael, can we go back to you?
Yeah, I think, again, let's just look at how financial institutions manage risk, right? So there is a standard framework that people use, that they have been using for, I think Jorgen mentioned cloud adoption, but I would say when financial services became digital in the late 90s, actually these frameworks were started to be adopted and evolved, and they have been evolving. So there is a risk framework that most financial institutions use for non-financial risks. It has been continuously updated to incorporate new things that have been happening. And under this risk framework sits a controls framework, which actually show you or make it transparent how an institution actually manages and handles individual risks that may come from processes, that may come from technology. So there's a clear taxonomy there as well. And we use that and basically fit it into the standard framework that banks or other financial institutions can now say, here's the framework and here's how it fits into how I'm doing things today, right? And it gives me a clear path on how to evolve what I'm doing today into tomorrow. So I think that's really the strength of the framework because it fits some of these new risks, and some of the risks are new because blockchain is a more community-driven technology. It's also open source, but we understand open source. I think the community-driven aspect will require some further evolution, but I think that also can be handled.
Thank you. Jorgen, may I ask your perspective as well?
I would say one of the misconceptions I would like to address is that incumbents are not innovative enough. I think, if you look back at everything that happened, and you mentioned a few over the last decades, we have been able to support the growth of capital markets throughout thick and thin, throughout any kind of innovation, and even any kind of crisis. And tomorrow is going to be no different. The challenge we see today is more the pace of innovation. I would almost be a bit caricatural if I say that, every 6 months you have a new trend. It was DLT, then AI, then quant, then it's coming back, and it's in cycle. What we see now, it's quite some resiliency in the fact that digital assets is not an if, it's a when, and we are addressing the what and the how currently. And we have to recognize that while we are progressing, I think, all the major institutions and FMIs are doing things in production. The time of siloed experimentation and the time of, trying to do things on the side is over. And what will work is the big partnerships and being able to bring people together. And when you look at the nature of the institution that we are, we basically are this connector of the markets. So because we already do that and we make the money flow between issuers and investors and with all the intermediaries for traditional assets, there's no reason why we should leave the digital assets on the side. And we should basically allow the combination of best of both worlds. So clearly that's a way we are going. And today we see strong support and I would say a combination of the three magical things that you need together to get scale and adoption. I talk a lot about scale and adoption because these are key. You have regulatory clarity, you have technological readiness, and you have client demand. And we believe we can play a key role in all that because I think that DTCC has over 100 trillion in custody. We do have a 40. And if you look at the full crypto world, it's 4 trillion. So we have a big role to play in actually being able to connect everything and have an industry-led discussion rather than a tech-led discussion.
Otto, would you like to
Well,
add?
misconceptions, you get me into the subject.
Yeah.
Jorgen mentioned something that I think has done harm and is slowly moving away, but that confusion between crypto and digital securities has done a lot of damage, created a lot of expectations on the wrong direction. That has to be redirected, not by being tokenized or by being digitized, and as it becomes equally risky as a cryptocurrency, right? That has to be disappearing. The second is the conception that blockchain and digitization is a technology problem. It's a technology subject that the technology teams should solve. Is not, right? I go back to the stakeholdership involvement. The risk management is the same. It just needs to be understood. Contracts are now smart contracts, right? So there's logic behind it that lawyers, attorneys within our legal counsels, compliance, everybody needs to be involved in how that construction goes. It's not a technology problem. And the third one is, we keep saying and hearing, is the future. It's not the future, it's the present. It's here, right? We need to learn it now, and it's going fast. So those are three misconceptions that I think this helps clarify, because when you read the RMF, you see how close we are and have been to the same dynamics that we are now applying on blockchain, right? And that calls into, like Jorgen said, collaboration. We cannot continue working in silos. It's not the markets, it's not Europe, it's not the US, it's the blockchain, right? So that interoperability, that openness by open source coding, by collaboration, by implementation and interoperability is necessary.
Speaking of collaboration, we mentioned earlier that RMF has been developed in a close collaboration of the industry leaders. So how should the industry cooperate together in order to make this RMF effective? Wyman, would you like to comment on that?
Yeah, I think the industry is already coalescing around sort of best practices for various types of risks. For example, the cybersecurity front, code audits are very standard. That's one of the mitigations that's recommended in the risk framework. And there are many providers now that provide code audits and they're happy to publish their findings and review the findings periodic cadence. And I think we see privacy preserving technology as a very important request as well from the industry. Understandably, while transparency is useful, it's good to be able to selectively decide when something should be made transparent versus confidential. And so this, I think the last panel spoke a fair bit about different types of privacy technology and approaches. At Ava Labs, we have a cloud service that we provide that comes with some privacy options. For example, we have encrypted transactions so that you can see a transaction has happened, but you can't see the amounts or necessarily the addresses that it transacts between. And we're seeing a lot of uptake. We've done projects with a number of banks and even sort of upstart fintech companies, and they very much want to move in this direction.
Thank you. Jorgen, would you like to add your perspective on collaboration, how to make these risk standards more effective?
I think collaboration goes beyond the pure risk standards. And I think, having this group of companies and what GBBC has been able to bring together in the ARM effort is quite unique. If you look back a few years ago, these people would live next to each other, but not necessarily collaborate. And now we know, it's a bit caricatural, but it's like one big thing. We recognize the DeFi, the TradFi, we recognize the conversions, we recognize the differences, we recognize how we should work together. And it comes to this kind of work saying, it's quite interesting, I think. And I remember the first kickoff meeting, we were like trying to figure out what was the right space, etc., for this collaboration. And definitely it goes beyond. And, we have been collaborating with DTCC, Clearstream as well, when it comes to supporting the greater good of the market for adoption, developing the digital asset securities control principle. So I think, collaboration is part of the DNA and it's just accelerating today, but it has to come with a purpose and value for the clients and the ecosystem.
Thank you all. Clearly, collaboration is at the heart of it. So let's look ahead. Let's see what might be the future of institutional adoption of blockchain technology. And I would like to address the question to all of you. So Jorgen, maybe we'll continue with you first.
Again, I would quote Otto, to be honest. It's not about the future, it's the present. I think, you will see some clear acceleration in all the companies going to production. Always, our go-to production is a safe and gradual way together with the regulator and the clients to make sure that we don't build something for the purpose of building it, but we build because it brings value and it's going to be used.
Yeah, I would say people always on network technologies, which this is, talk about a tipping point, right? I think we are relatively close because what we talked about today, makes it easy, explains how to use it. A lot of people are looking at it, implementing it. There's still some experimentation going on, but I think generally people recognize now's the time to actually build and scale. So I think we are, if next year probably there will be a lot more actually happening with actual securities and a lot of transaction happening.
Yeah, I agree. In the last couple of months, we've seen two large fintech companies launch their own blockchains. Right? Stripe has one for payments. Circle, stablecoin issuer, also is launching one. So I think they're gearing up for what they expect to be a lot of demand for stables, which I think will enable other types of tokenization that rely on stables as a minimum payment. And so I think the benefit of the risk mitigation framework with respect to this type of development is that it allows large public companies or even just any large enterprise to be able to talk about risk in a very sophisticated way, right? We look at sort of disclosures that public companies file in their annual reports, and so rather than just list out 10 pages of risk factors, they can talk about how they try to mitigate these risk factors. And I think for users and investors, that's very helpful because it allows us to make an informed choice about how they're approaching the different types of risks.
Well, I'm always against saying the future, but I do see a future where there is full interoperability. There's no more silos in terms of ledgers, because we move from silos in terms of jurisdictions and type of markets and assets to now being segregated by ledgers and languages, right? That should disappear. I'm hoping, that's my hope, that will disappear, because then it's really one single market where all the assets can be treated equally. And to the subject of the UN today, right, that is really sustainable.
Well, this is all a very compelling vision of what lies ahead. And thank you so much for this insightful conversation. I just want to repeat again that the phase 1 of the RMF has been completed and published. It's available for public consultation until October 3rd. We are going to start the second phase soon, and it will be completed by the end of the year, and next year we will continue with the third phase, which will be focused on the native digital assets. If you have any questions about RMF, we have our experts here, and I'm happy to answer your questions as well after this panel. Thank you so much, and a round of applause.